Stop thinking US money is welcome in China's tech sector. Seriously, if you are a US investor who thinks you can still back the next big Chinese AI startup, you are about to get locked out. Here is the counterintuitive truth that Silicon Valley venture capitalists are realizing right now. The era of US capital fueling China's tech rise is over. April 24th, 2026, a date that changes everything. China just told its top AI companies, no more US money without government permission. Moonshot AI, StepFun, ByteDance, all restricted. Why? Because Meta bought a Chinese AI startup called Manus, and Beijing did not like it. $2 billion acquisition just triggered a wall between US capital and Chinese innovation. Let me break down exactly what happened, and stay until the end for the 3 secrets that will change how you view every China-US tech investment from now on. I'll admit something. For years, I believed that US capital would always have access to China's best tech companies. Sequoia did it. Benchmark did it. Tiger Global did it. Why wouldn't it continue? I was wrong. Geopolitics changes everything, and I learned that lesson the hard way watching other markets close to foreign investment. Today, I'm going to show you exactly what China just announced. We're going to look at the trigger, Meta's Manus acquisition, the new restrictions, the companies affected, and what it means for US investors. By the end, you will understand why this is not just another regulation, this is a structural shift. Stay with me. Let's start with the trigger. Meta bought Manus. Manus is an AI startup founded by Chinese engineers. The company specializes in AI agents, software that can perform complex tasks automatically. Stock analysis, business proposals, code writing. Think of it as a supercharged AI assistant. The deal. Meta reportedly paid over $2 billion for Manus. The reaction in Beijing? Not happy. Why? Because Manus was founded in China. Its team was Chinese. Its technology was developed by Chinese talent. And now? That talent and technology belongs to an American company. China's concern. If Meta can buy Manus, what stops other Chinese AI startups from selling themselves to American tech giants? What stops China's best AI research from moving to Silicon Valley? The counterintuitive truth? China is not upset that Meta bought a company. China is upset that Chinese AI talent and technology are leaving the country. This is a brain drain problem, dressed up as a national security issue. Now, the new rules. What did China announce? Multiple Chinese regulatory agencies, led by the National Development and Reform Commission, or NDRC, have instructed top tech companies. Do not accept US investment without explicit government approval. Not maybe. Not we'll review later. Explicit approval. First, which companies received the guidance? 3 have been named publicly. 1. Moonshot AI, a leading AI large language model company. They are reportedly considering an IPO. 2. StepFun, another AI startup, also considering a Hong Kong listing. 3. ByteDance, the parent company of TikTok, the most valuable private company in China. ByteDance has been told no secondary share sales to US investors without government clearance. How strict is this? Strict enough that StepFun is reportedly unwinding its overseas corporate structure to comply. That means dismantling the offshore holding companies that made US investment possible in the first place. The counterintuitive truth? This is not a suggestion. This is a directive. Here is what most people don't understand. This did not happen in a vacuum. The US started this. In 2025, the Biden administration finalized rules restricting American investment in Chinese AI, semiconductor, and quantum computing companies. The US said, American money cannot fund Chinese military technology. Now China is responding. China's new rules say, Chinese AI companies cannot take US money without permission. The counterintuitive truth? Both countries are doing the same thing. The US is blocking US capital from going to China. China is blocking Chinese companies from taking US capital. It is a mutual decoupling. So, what does this mean for the future? U.S. venture capital firms, Sequoia, Benchmark, Tiger Global, have invested billions in China over the past 20 years. American pension funds and university endowments have been major backers of China-focused venture funds. That era is ending, not immediately, but the door is closing. Let me break down who wins and who loses. U.S. investors? Well, they lose. You simply can't easily invest in China's next AI giants, the companies that might become the next DeepSeek or the next Moonshot. Your capital is locked out of the world's second-largest tech ecosystem. Chinese startups also lose. You lose access to the deepest pool of venture capital on Earth. U.S. money has funded China's tech rise for decades. But now, no more Sequoia, no more Benchmark, no more Tiger Global. U.S. tech giants, it's kind of a mixed bag. Meta already got Manus, sure. But future acquisitions of Chinese AI startups? Those are going to be much harder. China will block deals that transfer technology to American companies. Now, from the Chinese government's point of view, they actually win. They keep AI talent and technology inside China. They prevent brain drain. They maintain control over strategic assets. But here's the counterintuitive truth. Everyone loses in a tech war. The Chinese government believes the cost of losing AI talent to the U.S. is higher than the cost of losing U.S. investment. They might be right. Or they might be isolating their own startups from global capital. Let me leave you with the 3 secrets that connect everything we just discussed. Secret number 1, the Manus precedent. One acquisition changed everything. Meta's $2 billion purchase of Manus was not just a business deal, it was a geopolitical event. China saw its AI talent and technology walking out the door, and they slammed it shut. Never underestimate how one deal can change an entire regulatory landscape. Secret number 2. The mutual decoupling trap. Both the US and China are building walls. The US says, no American money to Chinese AI. China says, no Chinese AI taking American money. The trap? Chinese startups lose global capital. US investors lose access to Chinese innovation. No one wins. Secret number 3, the sovereignty premium. China has decided that controlling AI is worth more than attracting US capital. That is a bet, a big one. If Chinese startups can find domestic capital to replace US money, they survive. If not, they starve. The winners will be Chinese state-backed funds and local venture capital. The losers will be startups that relied on American dollars. So, what should you actually do with this information? If you are a US investor, it's time to reevaluate your China exposure. The era of easy US capital flowing into Chinese tech is ending. If you already have positions in Chinese AI companies, watch for regulatory risk. The government could force restructuring that hurts foreign shareholders. Don't assume past returns will continue in the new environment. If you're a Chinese startup founder, start looking for domestic capital. Government-backed funds, local venture capital, Asian investors not based in the US. US money is no longer reliable. Build relationships elsewhere. And if you're a US tech executive, future acquisitions of Chinese AI startups will face extreme scrutiny. Assume any deal will trigger a government review. Budget for delays, budget for denials. The counterintuitive truth? The best opportunities might now be in countries that are not picking sides. Southeast Asia, India, Latin America. Capital flows where it is welcome. And right now, China is becoming less welcoming to US dollars. Here's my question for you. Do you think China is right to block US investment in their AI companies? Or is this a mistake that will hurt their own startups? Drop your answer in the comments. I read every single one. Like and subscribe if you want more analysis on the tech war and what it means for your money. I'll see you in the next video.